It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we've got George Mancherel, and he's CEO and co-founder of Bespoke Financial. George, thanks for being with us at the Talking Hedge.
Thanks for having me.
Appreciate it. Tell us a little bit about Bespoke Financial, how you got started, what your revenue model is, how you guys are operating.
Sure. Yeah. So just starting from the top, Bespoke Financial is a FinTech platform. We are a licensed commercial lender, and we focus on providing debt financing, non-dilutive financing to cannabis companies all across the supply chain. And our focus, if you look at our list of clients right now, we work with operators that really do span the entire universe when it comes to cannabis. We lend to borrowers in 15 states across the U.S. And in terms of the genesis of the company, prior to co-founding Bespoke, I come from a very traditional finance background. Worked in investment banks and asset management firms, always with a focus on lending and debt investments. And so, when adult use sales in California turned on in 2018, I'm a huge believer in the product that is cannabis and its potential going forward, just in terms of improving the quality of life, but also from a recreational standpoint. And so I saw a very exciting opportunity to move into a new industry. And so, with my background being in lending and debt financing, it was glaringly obvious that that didn't exist for cannabis. And so if you have the thesis that cannabis in a number of years will operate similar to any other consumer product industry, you can point to comps like alcohol, you can point to comps like tobacco, pharmaceuticals. All of those comp industries are reliant on functioning debt financing markets. And so the idea behind Bespoke was to really lead the path in terms of defining that market, and approaching this from a FinTech angle really did give us scalability in terms of being able to service a broad array of operators in as quick of a time as possible. And I think that was one of the compelling parts of it too, is that when you build an industry in the modern era, you can actually take advantage of the technological advancements that have happened, rather than trying to build a very old school sort of market or service.
Let's dive into a couple of things that you're offering, because some of it is fairly easy to understand. A lot of the audience, doesn't necessarily get involved with lending products, especially with cannabis. But I think some of it is fairly normal, like a line of credit, which is basically just a credit card. You can borrow from it, pay it back. Difference maybe with a line of credit is there's cash. You can pull cash out. Can you explain to the audience who may not understand the difference between inventory financing and invoice financing? One is from tangible products inventory. The other one is money that they might be getting as a service. So there's nothing tangible to take collateral on, but the process in which you do your due diligence, is it the same? What is the difference between inventory financing and invoice financing from a back-end standpoint?
Yeah, so just starting from a high level, all companies that are interested in our financing go through the same application process. Bespoke does not work with pre-revenue companies at this point. So we ask for just the standard financials for any company that approaches us. The analysis that we do and the products that we ultimately approve applicants for is dependent on a couple different things. One, the state of the company itself in terms of its own maturation. Obviously, if you have a more mature company with a strong balance sheet full of assets, you are inclined as a lender to provide more flexibility and freedom to that borrower, because there's just a greater collateral cushion there. However, if you have a company that's very new, or just because of the part of their supply chain, they remain very asset light, you're going to want to make sure that the capital you provide actually serves its purpose. And our goal is identifying companies that understand their business, understand their margins, and are really just limited by this access to capital, right? They can't take advantage of economies of scale, they can't move into new growth opportunities, but we want to provide that capital in a very measured way and in a very appropriate way. So, just looking at the two products you mentioned that we offer, inventory financing is, addressing the part of the challenge that companies like a manufacturer would face. if you're producing, let's say edibles in the cannabis industry, you have to go out and purchase raw materials, whether that's, the actual distillate that you would infuse gummies with, the actual edible product itself, the packaging associated with it. All of these are recurring costs and expenses for the manufacturer. And so by working with us with inventory financing, our borrowers can now go submit POs for the raw materials that they want. They can increase the size of their operations, purchasing more raw materials to be more efficient. And ultimately, what Bespoke does is we advance a payment directly to our borrowers' vendors for the product and the raw materials that our borrowers want to produce. Once our borrowers have the raw materials, then it's their job to actually finish production, ultimately sell the product to their own customers down the supply chain, and repay Bespoke so that they can recycle that capital and now put it into the next production cycle. The flip side of that would be the other product you mentioned, invoice financing. Let's say, that same manufacturer, for whatever reason, is selling to customers who are not paying them on delivery. So they're dropping off finished goods at a dispensary, but the dispensary needs to sell that product in order to have enough cash to pay the manufacturer for the inventory they purchased. Invoice financing is a tool that we offer that allows a company like this manufacturer to access capital that's tied up in their accounts receivable. So accounts receivable is just all these payments that they're waiting on receiving from their customers. With invoice financing, these companies can borrow against that pool and access that capital up front. And ultimately, the consumers would pay Bespoke whenever they're in a position to pay or they have time to pay. So depending on where the challenge is for any company that we're evaluating, whether it's in terms of sourcing new raw materials, whether it's dealing with the long cash flow collection cycle, the difference in our products is really meant to solve as best and as nuanced as possible the specific challenges for each company.
Can you tell us a little bit about what purchase money financing is? You talked about inventory and invoice financing. It sounds like purchase money could be thrown in, in one of those. I haven't actually heard of purchase money financing exactly like that. Maybe you can kind of explain what that is and why it might be useful.
Yeah, it's actually a hybrid of the two products that I mentioned before, and it's actually a product that works very well when you're dealing with, oddly enough, CBD companies. Or any sort of non-plant touching brand within the cannabis space. And so, I identified two different problems between sourcing inventory and collecting cash, but there are lots of businesses that sit right in the middle of the supply chain that have both pressures. And so purchase money financing is a tool that we have that allows us to do both with the same customer. It's effectively paying for the raw materials, advancing payment to their vendors, allowing that manufacturer to finish production of their goods and sell the product to their own client base, and then ultimately access whatever excess cash they can before their customers actually pay. And so Bespoke acts as a conduit of the capital. And really what this allows these brands to do is, instead of, worrying about how to pay their manufacturing partner or how to go chase up collections from their own customers, they're free to really focus on what their job should be, which is growing the brand and really building that consumer base. And so each one of these products, again, the qualification is different because, as you can see, there's different levels of freedom that any of the borrowers can have in terms of how they use our capital. Very different from our general line of credit, which is the most flexible form of financing we offer, where companies are effectively allowed to, either use the capital in terms of drawing it down themselves or advancing payment to their vendor. And so the distinction in tiers here and in product is really just meant to allow us to not have to say no to a new company that we think is very promising and could really benefit from our capital. And it's to provide enough versatility so that we have enough solutions so that any company, with no matter what side of the balance sheet they have the capital crunch on, we have some kind of service or a tool that can help alleviate that burden.
Do you ever make any exceptions? You mentioned you don't generally lend pre-money revenue, but if there was a CBD company and they haven't made any money, it's really easy to say no, good luck. But if you're looking at a limited license state and they need some capital to expand or scale or whatever, and they just haven't opened up shop yet to have that revenue generation, is that something that you guys look at anyways? Or do you just sort of wait until there is revenue? How do you look at kind of FOMO situations when you know there's going to be revenue?
Sure. Yeah. And I would say, expansion is totally different in our mind from a brand new business that's starting from the ground up, right? So if there's already an existing business, but the company decides to expand across the supply chain, so you have a cultivation arm and now they're moving into manufacturing, or you have a distribution arm and you're moving into the retail space. There's already an existing business, there's already assets where we could feel comfortable that our capital would be secured against something. So that actually is part of our process. And we've seen a lot of our clients grow and expand out in terms of their business focus using our funds. So that's very much something that we would look to service. It's a little bit different in terms of thinking about the opportunity or the FOMO, as you mentioned. We're lenders, and lenders tend to be more conservative because our outcomes are very different from equity investors. An equity investor who gets in very early, you're facing much higher returns, multiples of your capital if things go absolutely correctly. And that's the model that you see many venture capital firms, where they can invest in a broad portfolio of new companies, and not all of them need to succeed in order for the fund strategy to really work. With lending, it's very different. Our upside is capped. I tell our team all the time, our best case scenario is things go according to plan and you collect your interest and you get your return of principal, and that's the end of the deal. On the flip side, there's a innumerable number of ways where the deal could go sour, where the borrower might default, where the business comes under pressure and doesn't have enough cash flow to service its debt. And so for us, we're less concerned about missing out, because lending is going to be an integral part of all these companies for their entire operational lives. They're always going to have these capital needs, they're always going to have these purchasing needs. And so for us, we pause and wait until a company has some revenue, just so that we can actually understand what the margins of the business are, understand the effectiveness of the management team, really make sure that the team understands what they're building towards and how they would use our capital. And so we're necessarily a bit more measured, as opposed to an equity investor who would be mostly concerned in identifying the good companies early to get in on the ground floor.
I've noticed this year there's a lot more there's a lot of change in the way that folks are going out trying to generate revenue. So my day job is running a hedge fund that uses AI and ML for, taking advantage of the volatility, but also right now it's just capital preservation. And right now I'm also looking at like the Polaris equity fund, Rob Seacrest over there getting like between 9 and 12% annualized is really, really good. I've been to a lot of trading expos. In February, they were bragging about being only negative 3%. When I was in Monaco 2 weeks ago, they were bragging about only being negative 17% when the market is down like 30. So it seems like this is an advantageous time for debt equity on the commercial side. Are you able to take advantage of those opportunities, like a leaseback option, for example, with the dispensary financing? Tell me a little bit about those opportunities.
Yeah, I mean, the broad universe of debt for cannabis, I'd say, comprises of a handful of options. And really, the reason why there aren't more is just the federal illegality that currently exists. So, the sale leasebacks, the Polarises of the world, all of these are basically focused on the commercial real estate side. And I'd say that's probably the most well-defined and liquid space in the debt universe when it comes to cannabis, because these are commercial lenders. Valuations on a building are more or less standardized. You can add some premium or have some, cannabis specific projections to any licensed property. But for the most part, you're treating it as land and you're treating it as a facility. So it's much easier for investors to wrap their head around. And when I say investors, I mean the capital behind these REITs, the investors that actually put money into these deals that ultimately flow to these cannabis companies. It's much easier for them to wrap their head around what happens in the downside scenario. What do we do with this property if suddenly the tenant defaults? For us, we've never been active in the real estate space, exactly because we think, for the most part, that problem, there are good solutions that exist in the market. And second, there's a whole host, and I'd say, probably the majority of cannabis companies that exist in the country today don't actually own the real estate. They're on leases already with whoever the property owner is. And so providing a solution to that section of the industry, and that's what helped us, sort of define out our lending products as they exist today. All of our financing is really focused on the operational side of the business, whereas, the commercial real estate side, I'd say it's a different beast entirely, and it's distinct from what our core focus is.
Is it simply build it and they will come? There was an investor that I was working with on a project that was kind of like it was basically bringing in lenders and bringing in entrepreneurs together, lenders and borrowers. And it wasn't a matter of just kind of building this website. There was compliance behind it. And I'm wondering, Washington State is one of the second most strict behind New York in terms of, if you want to be a money transmitting service, for example, or anything, it's really, really strict. And I think people look at compliance and think, oh yeah, I have trace and tracking and that's all I have to do, or I have my state regulator or whatever. But there's so many more regulations when it comes to financing. What are some of the roadblocks or hurdles that you've had to go through in order to remain in business? Talk to us a little about the compliance behind all of this.
Yeah, so I mean, from day one, we've operated in a weird space, which is that, cannabis is legal on a state level, but it's illegal on a federal level. For us, we have always been very conservative in order to make sure that, exactly to your point, that both ourselves and the companies that we work with are in adherence with, both sets of regulation. And, we look at each state as its own market. And before we move into a new state or work with a borrower in a particular state, we have to do a deep analysis of exactly what's required of us, what's required of the borrower, and what's allowed in terms of financing activity. And so, hurdle wise, it's really been more of a question of investment before we move into a new market, making sure we've done our due diligence. Our review of applicants and companies, like I said, it's fairly standardized, where we do not just a focus on the financial analysis, but also rigorous compliance checks, right? Ensuring that these are licensed operators, ensuring that, we're doing searches on the management team itself, making sure that, through our on-site, audits and sort of meetings with the team, really understanding that the operators themselves are in compliance with everything that they need to be in compliance with, because, straddling both, the legal market and the illicit market, it's something that may work in the short term, but we definitely are focused on operators that see the long-term value here. And the only way to monetize that is really by being as adherent to the regulation, because enforcement is definitely light within this industry in general, but if it does hit, it can threaten your entire business and the future success of your business. And so for us, it's always been integral that we make sure we screen with very standardized procedures that any financial institution would use, KYC, AML, really just checking to make sure that we've filtered out all and any potential bad actors.
With a looming recession, do you think that's going to sink the cannabis industry, or do you think that Vice, sin stocks and sin products are going to continue to be what they are, which is a vice that people hold on to really tight?
Yeah, it's an interesting question. This has long been a theory for proponents of the cannabis industry. It's that similar to alcohol, similar to tobacco, that this would be a recession-proof product. And so there's two aspects. I'd say internally we've done some research, and we've definitely seen that there's a very high correlation between cannabis sales and alcohol sales in markets that have been around for the longest, right? That are somewhat mature and have somewhat normalized. A very, very strong correlation, close to 1-to-1. But the caveat there being that no legal market has existed during the previous recession. So it still is, untested in terms of practice. That being said, I think that, just the evidence that we've seen in states like Oregon, Colorado, and California really do point to the fact that cannabis has already become a consumer staple for its existing consumer base. And I think that consumer base is set to grow in the years going forward. That being said, a broader recession that reduces people's disposable income and inflation that further reduces disposable income will have an impact on ultimate consumer activity and consumer sales. So I think there's a strong balance between the two pressures that are both favorable and not. And oddly enough, cannabis is the only industry, especially in the mature markets, that's hugely deflationary right now. If you look at again, Colorado, Oregon, California, these are markets that are dealing with oversupply, oversaturation in terms of just biomass and product. You're seeing a shaking out in terms of brands. You're seeing consolidation across the industry. And so, to some degree, that is beneficial in the sense that consumers finally have a product where prices aren't continually increasing. But that being said, it's very difficult for businesses that have projected their forecast based off of much higher prices, and trying to figure out how they can continue to operate and sustain their businesses is definitely the challenge that's in front of them. Our take on it has been that this is the new normal. This is actually what you would expect to see in a good maturing market. You see supply catch up to demand. The whole anti-tax chorus in the cannabis world, and I think they've been right, has said, taxes really do make the illicit market stronger. It makes it harder for the legal market to succeed. Consumers generally don't like paying more for the same product when they could pay less. This deflationary tide, as much as it is hurting businesses, and they do have to, really take a look at their business models to make sure they can survive in this new paradigm. This is also how you win against the illicit market, right? You just get more cost competitive, and you're going to have to make it up on volume. You're going to have to make it up in terms of sourcing new consumers, finding new ways to attract newcomers into the space, new products to offer to the consumer base. But I think, if you didn't see this, it would actually point to, I think, more stress in the sense that this market isn't taking off as it should, or there isn't enough demand from the consumer side. And so, as painful as it is, and as sudden as the deflationary trends have been, I actually think it's it was only a matter of time, and companies that are expecting things to bounce back to normal or 2020's prices are going to be in for, I think, a very rude awakening.
Yeah, maybe Philadelphia, when they come online, won't be able to put the $7,000 a pound that they were maybe anticipating. All those people are going to have to come back down to reality. It doesn't take long, anyways. When a new emerging market has those high prices, it doesn't take long to start to see that dip in every single new rollout. Yep. Which leads me to my next question about what's the next, what subsectors are still attracting equity capital. You've got real estate at the all-time highs, and you can see in every major market, there's a massive amount of available real estate. And so once speculators leave and they're not propping those prices up, those prices will crash. Mm-hmm. If you have central bank digital coins repricing everything, who knows what prices are going to land at. So when we're in this uncertain market where real estate is going to crash, where commodities are sky high, and people are reallocating their own capital to away from cannabis or whatever else to essential goods and services because they can't afford anything right now, gas prices and everything else. What's left in the cannabis space to invest in from what you're seeing? Is it distressed assets on the West Coast? Is it new emerging markets and FOMO? And within that, East Coast, West Coast, which cannabis subsectors are still attracting equity capital?
Sure. Just starting with the equity capital question, the industry really went through a couple different phases of fervor. I would say, 2017, 2018, definitely there was a lot of, speculation, especially on the part of equity investors, that federal legalization was right around the corner in line with, Canada's legalization. That led to an ultimate, complete retreat from equity investors in 2019. And I'll be honest, there really hasn't been a sizable return to the market on the part of equity investors. You see it on the margin. You'll see investments in ancillary companies, and there are brands and there are companies that do manage to raise capital, but nothing at the scale that you saw in the years prior to it. And investors definitely have taken a much sharper eye, and you've seen investor demand kind of float around. 2019, 2020, there was, I think, a much higher interest in terms of investing in brands, with this idea of building the next national sort of consumer product brand, similar to a Coca-Cola of Pepsi. And so that ultimately, ran into the issues of state-specific regulation and state-specific marketing, and the lack of the ability for, one operator to really have good control of the consumer experience across multiple different markets, given the completely different dynamics that existed in each of those spaces. And so equity investors, I think, have rightfully so, because of the challenges and the headwinds that have, presented themselves to the industry, and the federal illegality, again, being a huge blocker. I think there's a lot of cautious, selective investments that are happening across the board. but it's significantly pared down. And this is actually the first year that you see debt financing. If you look at the cannabis industry and how it finances itself, there's equity capital and there's debt capital. This is the first year that debt's actually, well, I think last year towards the tail end, the trend got especially accelerated. But if you look at this year, the companies that are raising money are mostly choosing to do it. I'm sorry. Are mostly choosing to do it through debt capital and debt financing. And so for me, I look at this and I think, any equity investor should be excited about the cannabis space. But there are just regulatory hurdles that I think are keeping companies on the sidelines. How cannabis shakes out relative to every other investment that's possible in this in this environment, again, I do think it does have very compelling arguments, but the problems that plague it, a lot of them are political and a lot of them are regulatory. And so, that's very difficult for investors to really, front run. And at the same time, it just makes it incredibly hard for these companies to raise around it.
It has been incredibly difficult to raise. There's momentum. These Momo stocks move with the news rather than individual fundamentals, which haven't been used in a long time. So even technicals aren't being utilized in the cannabis space right now. It's just news. So I'm curious with that. Is the issuance of debt in order to avoid the dilution of equity shares, or is it FOMO that people are just willing to accept anything, whether it's debt or equity? I'm curious why there's an increase in debt issuance within the cannabis space. Is it simply because fundamentally it doesn't make sense, or is it because people just take whatever they can get?
I think it's a mix. It's a mix of those factors and more. In general, I do think the universe of debt capital providers has increased when it comes to cannabis specifically. Fundraising for us, since our founding in 2018, we've gotten a front row pulse on, what the broader investor universe thinks of cannabis and how active they are. And so there's definitely been improvement and an increase in the amount of capital that's looking and being deployed in cannabis. So the supply of that debt financing capital has definitely increased. I think the industry's educated itself a lot about how it can use debt, especially in legacy markets that turn to adult use. We ourselves have had to do a fair amount of education with companies that we speak with, just so that they understand exactly how debt financing can benefit them, and explaining really how it works that's different from equity capital. And so I think the industry's natural maturation, naturally attracting entrepreneurs that come from other industries and have a model of how they've built and scaled other businesses and how they've used debt in the past, is definitely helping the demand side for debt financing increase as well.
All right. We talked a lot, George. Is there anything I left out that you want to cover?
I'd say, the biggest news by far this week has been Chuck Schumer and Cory Booker's introduction of their CAOA Act, the broad swipe at federal legalization. And so, granted, it came out yesterday, it's 300 pages and I haven't read it. So caveat everything I'm about to say with that. And I think it's a huge pivotal moment for the industry overall. Personally, I don't expect that this version of the bill gets passed, or that it gets passed very quickly. There are aspects of it that I've seen that seem very, very positive and very beneficial for the industry, in terms of removing some of these hurdles for access to broader financing. Descheduling the plant itself. Those are good. I do think there are certain components that actually we'll have to see how the political environment responds to what the actual legislation says when it comes to the treatment of states' rights. And I think the bill is going to be very interesting to follow in terms of how it's debated, because I think especially when you look at state rights and interstate commerce, it tries to please all sides and may walk away not doing anything that it highlighted as being important or really serving some of the biggest objectives that the bill claimed to. Primarily being, states are theoretically under the current draft, states are allowed to decide whether cannabis is legal or not in their state. However, they can't prohibit the transport of cannabis between two legal markets through their jurisdiction. And I don't understand how that would feasibly work from anyone who's concerned with, a states' rights issue. And second, it kind of just turned this overall growth opportunity in this industry into a little bit of a zero-sum game, whereby, larger companies, mature markets would necessarily have an advantage over smaller cannabis companies and also newer cannabis markets, right? New York is going through their licensing, trying to establish a cannabis industry themselves. If something like this bill were in place that allowed for interstate commerce, there'd be almost no motivation to set up cultivation or manufacturing facilities in New York when you can just buy much cheaper product from the West Coast or any of these saturated markets, right? And so, I think those are components that I hope the senators and the politicians involved really do drill into, and each state really understands what the impact would be for itself, as opposed to using this rollback of prohibition as a really, really good opportunity to promote economic growth and undo the harm of cannabis's prohibition in communities across the country, rather than having it, the benefits of that reside in just pockets of the country.
Yeah, I spoke to Riv Capital, who spent $250 million going into New York to grab a couple of dispensaries. And I just said, you must know something we don't about the lack of legalization, because there's no way you would spend $240 million if legalization was right around the corner, which, has got everybody going to Florida to grow when the reality is long term, that's the worst possible spot you could have any kind of flower type product that's really dense, because you're just asking for mold and powdery mildew and spider mites and all those other issues. But that's just something that's going to have to play out.
Yeah, it's hyper regional, and again, I expect this bill to go through numerous edits before, if and when it is passed. I think that the huge silver lining and the reason why it should be very exciting is that there's never going to be one cure-all piece of legislation that undoes this prohibition of cannabis. It was always going to have to be a series of steps, and trial and error. We've seen states take vastly different approaches to legalizing cannabis, and some have worked better than others, and there's definitely lessons to be learned. But for us, it's anything that moves this industry further into legitimacy and really helps these operators is a huge win across the board. And nothing will ever be a perfect solution, but we're just starting this discourse, and so we'll see what the respective voices at the table have to say about it, and how this unfolds. But again, I think this is still a long journey ahead of us, and in the interim, companies really do have to continue to make sure that they remain operational and they survive and grow as much as possible, so that ultimately, whenever this does get passed, they're well positioned to take advantage of that momentum.
We're gonna have to wrap this one up, but I think that ultimately the biggest takeaway might be the 280E. If they get rid of 280E overnight, these companies will be able to be profitable, and I think that'll be the biggest component to all of this. Banking is already there. Interstate commerce will help the redundancies, but that 280E aspect, I think, is going to really make a lot of these businesses profitable more than any other single individual component. I think will have the biggest impact.
I agree.
All right. Well, let's leave it with that then. I want to thank my guest, George Manchero. He is the CEO and co-founder of Bespoke Financial. Where are you guys at? Social media, website?
Yeah, so we are our website is bespokefinancial.com. I'd say that's probably the best avenue for any company that's interested to explore financing or start the conversation. Please do feel free to reach out. And thank you again for having me on the podcast today. It was really fun chatting about all this with you. Yeah,
appreciate it. George Mantrell, CEO, co-founder of Bespoke Financial. Appreciate you being on the Talking Hedge.
Thanks, Josh.
I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.